Live from the City of London for our audience worldwide, I'm Jonathan Ferro. Equity futures down about 0.5%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Coming up, the S&P 500 closing above 4K for the first time this year. Investors choosing to ignore debt ceiling talks down in D.C. and preparing for Microsoft to kick off mega cap earnings. We begin with the big issue. Here comes big tech.
The big tech stocks.
Big tech.
Today, the market is happy with tech stocks.
Microsoft, seeing a nice bid to it. You're seeing Alphabet bouncing back here.
The rally, no doubt.
Some of the tech names, have become a lot cheaper than they were.
But I'm not sure that that's going to continue.
The story this year is the earnings risk and the recession risk.
The economy rolls over into recession, and it's very unlikely stocks will hold up. That's not priced.
There's a borderline question of a soft landing in the U.S.
Listen, we're about to enter into an earnings recession.
You have had circumstances where there has been an earnings recession without that economic downturn.
We hope that the Fed will engineer a soft landing here in the U.S.
There is an opportunity for the Fed to perhaps orchestrate a soft landing.
Joining us now to discuss Academy's Peter Chair, Lisa Hornby of Schroders. Lisa, first to you. These are your words. The bear market in risk is not done. Why is that?
I think some of your guests earlier alluded to it. We think that this year is going to be about the growth downturn and the earnings downturn. And if it is, we don't think risk assets are properly pricing that in, especially at the moment. Credit has been on a remarkable tear the last couple of months. Our estimates suggest that investment grade and high yield credit are discounting around a 1% to 2% growth rate in the U.S. We think that's entirely too optimistic based on the leading economic indicators that we look at. And so
Pete, you
we
agree.
think there is some downside
Equities
risk
are up,
to come.
the Nasdaq's up, the S&P's up, Euro Stoxx 50's up. Lisa's talking about credit. It's not just credit, it's equities as well. I've got the Nasdaq 100 up by 8.5%. Peter Chair, a lot of people are wondering whether they should chase this. And you say, resist the urge to put dry powder to work. You agree with Lisa Hornby here?
Yeah, we've been fairly bullish coming into this. We thought people were going to mistake weaker data for this potential for soft landing. Everyone's hopeful the Fed's going to fix things. I think it's going to start really deteriorating, and we're going to hit this point where bad news becomes bad news again. And that's what I'm looking for, is weakness across the board in equities and risk assets.
Pete, how much bad news do you see right now? I mentioned jobless claims a few times this morning, 190,000. That seems to be the thing that's pushing back against that bearish narrative.
So I'm generally ignoring jobs, obviously with some risk on that. But I think jobs is always lagging, and it's going to be particularly lagging this time. We just went through a year and a half, 2 years where people had so much difficulty hiring people. They're not going to let them go soon. So I'm looking for other things. Last week, Wednesday, I believe, it was an awful day for me. You had retail sales go down, which is bad enough, but inventories kept building. It's the inventory build that we've seen in consumer goods that concerns me. And I think we're going to see a similar pattern in the services industry, where there was this huge demand pulled forward late summer, spring, fall, and into the holiday season. And I think that's going to drop off as well. So that's where I see the problems.
Soft landing is the new transitory, seems to be the theme over at BNP Paribas. Carl Riccadonna leading this effort, him and the team writing the following over at BNP. Soft landing has been the catchphrase of a still young 2023, but we think it will go out the window in the same fashion as transitory inflation did in 2022. Lisa Hornby, I'd love to get your view on that, your view particularly. Do you agree with that?
Yeah, I think there's some merit to that. I mean, look, we look at the consumer data in a lot of detail, and consumer spending has been held up over the last couple of years because of a tremendous amount of fiscal transfers, because savings rates have been relatively high. But we think that the consumer is more challenged heading into 2023. We've seen a lot of that savings been drawn down. We now look at active savings, the actual savings rate at this point in time, at basically historical lows. The only time it was worse than this was in 2005. We just see, with negative real income growth continuing, at least for the foreseeable future, we just think it's going to be hard to maintain that same level of consumption. And case in point, we have seen credit card expansion. So revolving credit has expanded by about 15%, which means that consumers are in fact tapping into debt in order to continue to fund their payments. That's not a perpetual, that's not something they can do forever. That's temporary. And we think that's where things start to get weighed upon. I would completely agree with Peter on the job side of the equation. That does tend to be a lagging indicator at best. And so what we would expect to see is we'd expect to see some softening on the consumption side, and then eventually that turns into job losses. It's slow going for sure, but that's actually typically how it is at this point in the cycle.
Pete, is soft landing the new transitory?
Yeah, I think it's going to disappear. And I did steal this, I think, from Tom Keene months ago, this idea of a pendulum. And we started at this really good point. And if you take a snapshot, it looks okay right now. It's going to swing all the way through. I think we're going to have a hard landing. It's going to be longer. And I think the epicenter of this is going to be around big tech, semiconductor businesses. Kind of the latest phrase that we're talking about is that tech took 5 steps forward post-COVID, and it's going to take 2 steps back. Everyone's rethinking. There's some spending curtailing going through that. So that's going to be the epicenter of the problem. It's going to flow from there.
Pete, can we just sit on big tech a little while longer? I went through the numbers yesterday. Let's do them again. Microsoft cutting 5% of the workforce. Looking at Alphabet doing 6%, Salesforce doing 10%, Meta doing 13%, and maybe still more to come. Pete, why do you think that is a big story? Because a lot of people might look at that and just say it's one industry. There was a ton of excess in the last 2-3 years. That's going to unwind. This isn't the big, broader economic story you think it is.
So I would push back that if you look at the disruptive companies, the employees of the disruptive companies, anything that private equity is investing in, right, where there was this ability to raise money and your whole goal was to spend that money as quickly as possible so you could move on to the next raise at a higher valuation, that's all gone. So all their customers, I think, are under a lot more pressure. I think companies are rethinking their push to big data, how they're going to use AI. So everyone's a little bit holding back. So I think this is just the starting point of this. And then on top of that, there's clearly friction going on with China at the high end of chips, but whether that feeds into the low end of chips, what goes on there, I don't want to call it, World War 3.1, but there is a real friction between the U.S. and China on high-tech chips, and that's filtering the way through the system. So there's a lot that is not yet being felt in this market, I believe.
Microsoft results coming a little bit later after the bow. We'll catch up with Ed Ludlow at around 9:30 Eastern time, so about 24 minutes from now. Corporate earnings across the board this morning, interesting. Continuing to tighten the belt seems to be the theme over in corporate America. 3M joining the growing list of companies cutting jobs. 2,500 to go. The CEO, Mike Roman, saying this: a necessary decision to align with adjusted production volumes. We expect macroeconomic challenges to persist in 2023. Katie Lyons has more. Hey, Katie.
Hey, John, this is becoming a literal daily occurrence, me coming on here and talking about a new company announcing job cuts. Those 2,500 job cuts from 3M you mentioned are specifically in manufacturing, and they are global as the company is contending with weakening demand in many of its segments. And the company doesn't expect that to get all that much better in the near term. Its guidance came up short of expectations, which is why the stock is down the better part of 5% before the bell. They missed on the guidance for the top line and the bottom line. And importantly, margins also were expected to be tighter than what the street was projecting. So that's where the cost cutting comes in. They are trying to retain more profit, hence your Tuesday layoff news, which of course follows a Monday in which we had more layoff news. Ford cutting about 3,200 jobs across Europe, or planning to, after they already eliminated 3,000 jobs primarily in the U.S. last year. Then you had Spotify's announcement yesterday that it was laying off 6% of its workforce. Before that, Apple, Microsoft, Amazon, Salesforce, Meta, Twitter, which you mentioned, a wave of job cuts across the technology sector in particular. Nearly 100,000 were announced over the course of 2022. We've had tens of thousands more already just in the month of January, the first month of this year. And of course, they're starting to hit the financial sector as well. Goldman Sachs, one of the primary examples of that. And what all of those companies I just mentioned have in common, John, is something you were just alluding to. They built up their headcount substantially over the last several years. And now that the economy is softening, they're having to cut back.
Katie Lyons, thank you. We'll pick up on that story again in about 20 minutes. Looking forward to catching up with Andrew Sliman of Morgan Stanley. Just taking a look at the market right now, going into the opening bell, 22 minutes away. Equities down by 0.5% on the S&P, on the Nasdaq 100 down 0.7%. I think this week alone, a quarter of the S&P 500 reporting earnings. If we take a snapshot of the bond market, 2s, 10s and 30s, yields lower over the last 3 or 4 months. Back in October, the 10-year topped out at about 433, 434. Right now, about 351. The 2-year topped out close to 480, right now about 423. Lisa Hornby, yields lower the theme since the October highs, or at least the highs of the last 6 months or so. Lisa, can you help me answer this? I wrote this one down because I was really thinking about it yesterday evening. Are we pricing in cuts because we think there will be a soft landing that doesn't require high rates? Or are we pricing in cuts because we think there's going to be a hard landing that requires loose policy? Which one is it?
I think that is a great question, and that is sort of the inconsistency that we've been highlighting in the market, right? The market thinks we're going to get to this point that risk doesn't deteriorate enough, the economic data doesn't deteriorate enough to actually impact risk markets, but the Fed is still cutting rates. So I think the market is discounting some of a Goldilocks scenario, right? Things slow quite gradually, inflation has come down by just enough to not actually impact consumer demand very much, and therefore the Fed can loosen policy a little bit and we're kind of off to the races. I think that's a really optimistic scenario. And not only is it optimistic, historically, it's basically unprecedented, especially when you have the tightest or most aggressive hiking cycle that we've had in 40 years. So I think there is a bit of an inconsistency here. The yield curve, which is an indicator that has historically worked very well, is telling you with the curve as inverted as it is, a recession is likely. It is imminent. There's somewhat of a lead time between the curve inverting and actually getting the recession. So it could be anywhere between the next, let's say, 6 and 12 months. But I think it is coming. And I suspect the market will move on to that narrative in the coming, let's say, 6 weeks to 3 months period.
The 2-year 10-year curve right now, negative 72 basis points. Peter Cheer, how much signal's there?
I think there's been a lot of signal in that. The one thing that I've been watching is Waller came out on Friday saying he's comfortable doing QT regardless of what they're doing with rate hikes or cuts. And I think that's going to be really important. To me, QT weighs on the markets. I think treating rate hikes, rate cuts, and QE and QT similar, it's just wrong, right? I think it's like salt and pepper. They both make your food taste better, but you've got to be careful and they behave very differently. So I think we've got to start preparing for a world where we have QT for a year, 2, 3 years. And I think that is going to be a weight on risk assets. It tends to directly affect risk assets. I think the Fed's trying to use that to steepen the yield curve, take some of those signaling noises away. I think that's going to fail. I think what it's going to do is keep a lid on stocks and high yield and junk bonds and the riskiest assets from performing very well.
Pete, when you hear long and variable lags, do you also hear just a fancy, sophisticated, educated way of saying we've got no idea?
I keep having this image that they've pushed the economy over the cliff, and instead of just watching it, they're pushing it further down. It's already falling. It's already heading down. They should be worrying about trying to catch it, making sure there is the soft landing, and they're still pushing. I think it's ensuring that we have this hard landing, and if it wasn't for the ghosts of the past, had they not missed transitory so badly, I think we'd be having a much different discussion, and that's one of the problems. I think it's almost like a stop-loss situation as a trader. You've made mistakes, so you're not thinking clearly. I think that's where we are at the Fed. They should have been watching this and preparing for a soft landing 2-3 months ago. The fact they didn't is why I think we're going to have such a hard landing.
They're scarred by 21 and conditioned by the 1970s. Lisa, do you agree?
I think there's some of that. I think the other point that we haven't touched on yet is that financial conditions are still easing or are materially easing. They're actually back in positive territory now. And, the central bankers back in December, and I think Powell was at the forefront of this, spoke about the risk of unwarranted loosening in financial conditions. And I think, unfortunately, the reality is that if financial conditions loosens, it actually makes their job more challenging. And they actually have to end up being more aggressive or speaking more hawkishly than perhaps they otherwise would. And I think that's part of what we're going to hear next week when Powell speaks. Is I think he's going to push back on this idea that the market is pricing in rate cuts. I think he wants to telegraph the narrative that, hey, look, we are going to get to perhaps 5% and we're going to stay there for a while and see what happens. We're not in any rush to start, to start cutting rates.
Lisa, just one more question from me on how you think about the way this works. I just want to read a line from Vice Chair Brainerd's speech from last week, and she talked about the long and variable lag. She said this: "It is likely the full effect on demand, employment and inflation of the cumulative tightening that is in the pipeline still lies ahead." Lisa, with that in mind, how much of the recent easing undoes some of the cumulative tightening of the last 12 months?
I think it undoes a good amount of it. I mean, look, capital is still not free. At the end of the day, the cost of capital is much, much higher than it was 6 or 12 months ago. And I think that's the long and variable lags, right? We know that this will impact investment decisions for the foreseeable future. But at the same time, you have undone some degree of that, right? Because at this point now, the market is not only looking through the rest of the hiking cycle, but predicting some rate cuts in the back half of this year and then early into next year. And so that undoes some of that impact. And, we're actually seeing it in mortgage rates. Mortgage rates, right, have come off their highs. I think they were north of 7% at one point towards the end of last year. And now they're back in the 6% range. Still tight, but not as tight as they were before. Still having an impact, but perhaps not as much as it was before. And I think that's the point. Inflation is coming down, that's quite clear, but I think it might be hard for them to get inflation from, let's say, 6% where it is now. From 6 to 4 will be easy, but from 4 to 2 might be more of a challenge. And I think that they are certainly worried about that. I think they're worried about the playbook that happened back in the late 70s, early 80s, where they were too easy to cut. And then they had to go back and reassert themselves in a much more aggressive program. And that's where it comes back to the, citing Volcker and learning the lessons of the past.
I keep thinking back to that line from Sarah House of Wells Fargo, the last mile from 4% down to 2 is going to be the toughest mile. Lisa Hornby, Peter Cheer, two bearish views on this panel right here. They're going to stick with us. Coming up, debt ceiling talks picking back up in D.C.
Brinksmanship, hostage taking, default on the debt should be off the table. At stake is the health of our economy and the very stability of the global financial system.
That conversation up next. A massive earnings week coming right up. 25% of the S&P 500 reporting. It all kicks off big time with Microsoft after the close. Going into the opening bell, equity futures negative 0.5% on the S&P. The Nasdaq down 0.6%. The Nasdaq 100 year to date absolutely flying. We'll pick up on that in a moment. There's your opening bell. Switch at the board and get to the bond market. Yields look a little something like this on a 10-year. Your 10-year yield doing nothing at 350.97. Some important PMI data coming up in about 15 minutes. We'll break that down with Mike McKee. Euro-dollar 108.63, the composite PMI out of the Eurozone above 50 for the first time in expansionary territory going back to June. Euro-dollar still negative by about 0.1% on the day, and just to round things out for you, crude just short of 82. We're positive about 0.1% or so. The opening bow then, we're a little bit lower, about 20 seconds into this. We are down by 0.5% on the S&P 500. On the Nasdaq, we're down about 0.5%. Also, one stock to watch at the open is 3M, delivering a downbeat outlook and announcing plans to reduce its workforce. The CEO, Mike Roman, saying the following: "We expect macroeconomic challenges to persist in 2023. We will reduce approximately 2,500 global manufacturing roles, a necessary decision to align with adjusted production volumes." Abby has more on the story. Hey, Abby.
Hey, John. Well, yes, a rough morning for 3M, and indeed having its worst day right now since 2022, August of 2022. What's really interesting, we have a lot of circuit breaker issues at the NYSE right now, it appears, based on my breaking news, my news headline. And this stock on the open at one point down 16%, its worst day since 1987. I don't know if that'll hold, but yes, a bad day, a bad year, and a bad 5 years for 3M. You and Kaylee earlier were talking about the layoffs, 2,500 manufacturing jobs cut. That is certainly a piece of it, but it also has to do with the earnings miss. A messy quarter, really. Sales basically in line, and then, of course, that weak outlook, also a piece of what's going on. The CEO mentioning those macro headwinds. Now, this company, of course, makes everything from Post-it notes to surgical supplies. Healthcare is the only segment, though, John, that is growing. Healthcare growing by 20%. Consumer, safety, industrial, transportation, electronic, all down. So net, we are looking at 2% growth. Not great for this conglomerate. Meanwhile, the company is facing liabilities all over the board relative to their military earplugs, plus on a carcinogenic fire foam. So over the last roughly 4 years, this stock down about 44%. Over the last 5 years, down about 50%. Really underperforming, as you can see, the industrial sector, which is up close to 50%. So 3M's woes continue. It doesn't really seem like there's a bright spot for this stock at all right now, John.
That stock getting absolutely hammered. Abby, thank you. Let's stick with earnings. Some mixed results from the home builder, D.R. Horton, this morning. The home builder topping estimates as the C-suite delivers a warning on the challenging environment, saying the following: "We've seen a moderation in housing demand caused by significant increases in mortgage interest rates and general economic uncertainty. Katie Lyons has more. Hey, Kaylee.
Hey, John. Yeah, they did manage to deliver that beat on the bottom line, which is likely why we see the stock up about 2.3% at the opening bell. But just to put that profit into context, it's down about 41% sequentially from the prior quarter and down 13% year on year. So, yes, a beat, but we still have to keep that in mind. And where you're really seeing the pain in the housing sector showing up is in their purchase contracts. Those were down about 38% from a year earlier. So those quarterly orders actually missed expectations. And on the call, executives did warn those pressures may persist. They said expect revenues to drop in 2023 along with prices and gross margin because they are still offering incentives to drive buyer traffic. Those incentives like price cuts and mortgage rate buy downs do come at a cost and weigh down margins. The company's gross margin on home sales fell to 17.5%, down from 21.2% a year earlier. But if there is a bright side to look at, John, it's that mortgage rates aren't as high as they were. The average 30-year rate has fallen from 7.4% back in November to just about 6.5% net now. And that has led to improved home builder sentiment as well. It actually rose this month for the first time since the end of 2021. And that has improved sentiment in home building stocks. By extension, that Spider S&P Home Builders ETF, which is what we're looking at here, has started off 2023 strong, up about 9% in January so far, which does put it on pace for the second best month in about 2 years, John.
Katie Lyons, thank you. The stock up by about 1.9%. Microsoft, the big one after the close. Guggenheim giving the stock its first sell rating in more than 3 years going into the print, saying this: while most investors see Microsoft as a large, stable business that can weather any storm, it does have vulnerabilities, some of which could be exacerbated by this macro slowdown. Ed Ludlow, that in the last couple of weeks ahead of earnings after the close.
Yeah, Microsoft is what we're bracing for because they're the first mega cap up. Fourth quarter earnings for information technology stocks on the S&P 500 forecast to drop by 9%-ish from the same period a year ago. But that would be the steepest decline in profit or earnings since 2016. You know, Microsoft's top line growth at least was kind of the poster child of the pandemic era. But if we bring up this terminal chart, this is going to be the first quarterly top line growth that's sub 10% for a really considerable period of time, going back 22 quarters. So there is the one question, right, which you posed at the top. Moving from the pandemic era of growth to a recessionary environment, how is Microsoft set to fare? We know they laid off 10,000 workers last week and that they'll book a $1.2 billion charge. As a result of that, that translates to a 12-cent hit to EPS when we consider the bottom line. That Guggenheim call, really interesting. It downgraded from sell to neutral on January 17th. It was the first sell rating on the stock going back 3 years. But this is just the start, John, of what I'm expecting to be a very long earnings season. And again, go back to your open. How does Microsoft fare in this environment relative to others? That's, I guess, the question and the benefit of going first this earnings season.
Mega cap tech results start after the close. Ed, looking forward to your coverage over the next couple of weeks, that's for sure. Morgan Stanley's Andrew Slimman looking for investments that could outperform in any earnings environment. He writes the following: if we have a recession, earnings are too high, soft landing, and earnings might be too low. It's a binary outcome. He goes on to say, so we like the areas already pricing in a recession and where central banks aren't tightening. We like the home builders and China. Andrew, I'm pleased to say, joins us right now. Andrew, buddy, good to catch up. Let's start there. The home builders. The home builders, why?
Well, look, you just mentioned it. Not a very good quarter and the stock's up. Why? Because they got decimated last year. These stocks are early cycle stocks. They're telling you that mortgage rates are going to come down in the future. So even though it wasn't a great quarter, this is why the stocks are up. So when you think broadly about the stock market in general, I just think you want to find companies that already reflect, not a great earnings season for 2023.
Well, we mentioned D.R. Horton. That actually bottomed last summer, I think, in June, and the stock's up 50% since then. Is that a decent name, or are there better names out there?
Well, yeah, I think that's a very fair point. I would look beyond the initial home builders to some of the home furnishing stocks, because don't forget, consumer discretionary as a sector was down 37% last year. Consumer sentiment, according to the University of Michigan, hit an all-time low. And I think you want to move beyond. Well, if the home builders have started to recover, maybe that means home furnishing, home apparel, anything home-related that aren't up nearly as much. Those are opportunities I would look to, especially because they fall in that consumer discretionary group.
Andrew, can I just ask, who's going to be buying these houses? There's going to be a whole generation of people locked into 3% interest rates. They're not moving anytime soon. Where does that demand come from?
Well, rents, look at rental income. I mean, rents are sky high right now. Now, the other thing to keep in mind is, yes, housing's turned down, but because new housing starts weren't able to be completed last year because of a lack of supply, there's not this huge glut of houses already built like we saw in 2008. So I think it's a very different situation. But again, remember, you have to think about what does these stock prices reflect, and I think it's a lot of negativity right now.
You mentioned China and China reopening. Europe certainly grabbing hold of that story and running with it. European equities on the Stocks 50 close to up 10% year to date. The other question I have really is not what's happening in Europe and China. It's what's happening in the United States. I hear a lot of people say buy international, avoid the United States, it's too exposed to tech. Tech is absolutely ripping, actually almost keeping up with what's happened with European equities, Andrew. Why is tech running so hard?
Well, I think, again, it is a case of it got decimated last year. Look, there's no question in my mind earnings aren't going to come in great. But the key question is how much of that is already priced in from last year. A great little statistic, Jonathan. The last 11 times we've had a down earnings year for the S&P, the market was up 9 times, right? 9 times. So all that implies is stocks already reflected a down earnings year. This is why I think the NASDAQ is ripping. Now, I've got to say short term, be careful, because anytime you have a situation where the NASDAQ is ripping going into earnings season, that's a dangerous scenario.
Andrew, I'm going through some of the cuts. We talked about them earlier with Peter Cheer of Economy, just some of the job cuts out there at the moment in that sector. Some of it's brutal. Meta, 13% of the workforce, Salesforce, 10%, Alphabet, 6%, Microsoft, 5%. When you see that, clearly that's bad news for the people on the wrong end of it. For the stock specifically, Andrew, is that good news? Does that make a material difference?
I was shocked after third quarter earning, when I listened to the third quarter earnings season in October, how these companies were very, they didn't seem to understand the downturn in the economy. And I think they're coming to realize in a quick fashion, and I think this is one of the reasons why the stocks got hammered in the fourth quarter, and they're coming back because management is proving that they are willing to pivot off this perpetual growth, reign they've really been in for, over a decade.
We've had the valuation challenge. Fed funds has gone from 0 through 4. I get that. Have we seen the earnings challenge? Yeah, Andrew, for some of these big names. I want to go back to that quote from Guggenheim. That first bearish call in something like 2-3 years on one single name, it was Microsoft, who said the following. This is Guggenheim. Most investors see Microsoft as a large, stable business that can weather any storm. It does have vulnerabilities, some of which could be exacerbated by this macro slowdown. We've seen the rates challenge. Have we seen the earnings challenge yet? Are we priced for that?
Yeah, I mean, those comments would strike me as perfect for what I heard out of third quarter earnings report last year. Are they, but now they're recognizing that they can't weather the storm, and they're making cuts to businesses that were less profitable. So I think the setup is actually, not bad going into earnings season because expectations are very, very low. So again, I just go back to these companies are pivoting and they're telling you, hey, no, we recognize we need to make adjustments to our business. And I think the market likes that.
So if I gave you a choice right now, just a final question, a choice between the cap-weighted S&P 500 or the Euro Stocks 50, which one would you choose to hold for the next 12 months?
Well, the problem with the cap-weighted is I think many of these big companies are coming under the thumb of the U.S. government that's going to slow their ability to make acquisitions and grow. That is a bigger story than earnings, which is, the Department of Justice is looking into these companies. And that, when you look back in history, that's always what brings down the biggest companies, that slows, they're knocked off their pedestal as the largest companies. So I wouldn't bet on the S&P cap-weighted versus European index. I might bet on equal-weighted but I'm not sure cap weighted.
Andrew Sliman on the latest. Thank you, Andrew. I want to head back to Abby just on that breaking news around the opening bow. Abby, let's go back there. What's happening to some of these halted stocks?
Yeah, it's really interesting, John, because that news came out and it was very different from what we usually see on the tape at that time. But stock after stock after stock, basically most NYSE stocks were paused for volatility. And as I had mentioned earlier on 3M, it showed a print of being down 16% in the first minute or so. So that suggests that there was some wild trading. But stock after stock from Nike, basically Occidental, they're all resuming now. So basically, overall, NYSE has said that the trading, that they're open, that they've seen an unusual number of halted stocks. And on J&J, it's interesting because this stock in the pre-market had been up, it had been down, and now, right around the time of the open, our internal Bloomberg system showed that it had been down for some range. Now it's showing that it had been up as much as 4%, and currently it's hard for me to actually even tell how much the stock is up. It looks like it's up just slightly at this point. And they, of course, put up a little bit of a disappointing quarter. They boosted their full-year earnings outlook. A bit of a surprise, John, of course, given the concern over the future of their COVID shot. The drug unit sales rose by 2.3% last year, but were up 4.3% without that COVID drug. The Street, their guidance had been for 2.4% or 2.4 billion or so. The range is above. Consumer health, the least contributing to the overall outlook. Pharmaceutical was the best in the fourth quarter, more than 50% of revenues. But again, this NYSE trading situation, we'll be watching it all day. It's really pretty interesting. It's also interesting, John, because you have been talking about this rally all morning. This stock, Johnson & Johnson, healthcare, those stocks are all down this year.
Abby, thank you on the latest. On the breaking news and what's happening with J&J as well. The broader equity market, for what it's worth, for 15 minutes into the session, we're down about 0.5%. Coming up on the programme, another dose of optimism for the Eurozone.
We're seeing upside surprises in the data. This feared recession, the food and energy crisis, which was so talked about last year, is just turning out to be less threatening than expected.
That conversation up next.
This is Bloomberg The Open. I'm Lisa Mateo, live in the principal room. Coming up, Johnson & Johnson CFO Joseph Wolk. That conversation at 10:30 a.m. Eastern, 3:30 p.m. in London. This is Bloomberg.
We're seeing upside surprises in the data. This feared recession, the food and energy crisis, which was so talked about last year, is just turning out to be less threatening than expected. And so I think there's a very good case for Europe to at least outperform some of those really downbeat expectations.
Let's get you some breaking news. We can get that with Mike McKee right now. Hey, Mike.
Hello. Eric Robertson was right about upside surprises. We get that in the S&P PMI indexes for the United States, which just crossed, with global manufacturing coming in at 46.8, up from 46.2. The services index 46.6 from 44.7, and the composite index 46.6 from 45. So it looks like an upside move on all counts, except for the fact that we're still under 50 for those. But different story in Europe. He was talking about upside surprises there. We got that for most of the indicators in most of the European countries. The French went down by just a tick in terms of the composite, but manufacturing was over 50. Services were basically unchanged. Germany did drop a little bit on manufacturing, but services went over 50 in Germany. And the Eurozone, in terms of the overall Eurozone, the S&P Global consensus there, 48.8 from 47.8 for manufacturing, and the composite 50.2, while services are at 50.7. So definitely a floor underneath all of the bad news in pretty much every category from S&P today.
Mike McKee, thank you. I'm happy to say that Guy Johnson's alongside me to talk about some of this. Guy, that's the first sub 50, or rather sub 50, north of 50 read we've had on the Eurozone composite, going back to June.
Europe's got really lucky. Europe has got really lucky. Gas prices have come down really sharply. China has reopened. Everybody's getting hold of that narrative. The direction of travel here is really positive. In isolation, John, these are still fairly depressed numbers, but it's where we've come from. It's the direction of travel, and it's really positive.
The ECB emboldened to go 50, 50, 50?
Well, the third one maybe, but certainly the narrative over the last few days has been a fairly hawkish one. Yes, you've heard from people like Visco and Stunaras,
sure.
But they feel like they're in the minority right now. Yes, you would have thought, judging by current market pricing, that at least two 50s are bolted on. The Bank of England looks like it's probably going to go 50 today's UK data, fairly depressed, but again, it's the direction of travel. And you take a look at some of the optimism indicators within this data, also fairly positive.
I've asked this question a few times this week. I'm sure you've done the same with your guests. Most people expect the ECB to hike more than the Federal Reserve this year. Are you hearing the same thing?
Yeah, but you've got to remember the ECB is playing catch-up.
Sure, to some degree, yeah.
So I think there is an element of kind of the timelines being a little bit sort of out of kilter. But
6 months behind.
It feels like the Fed's guiding us towards 25. It feels like the ECB's guiding us towards 50. Hence, you've gone from kind of a sub-1 euro to a, what are we, 109, and people talking about further upside to go.
I wondered whether the ECB could hike at all this cycle. Yeah. Never mind 50 basis points, 50 basis points, 50 basis points.
But we've come back, so a number of things have happened. You've been relatively lucky in terms of the economic data, so that has created the potential for more demand to come through. So the ECB is going to have to react to that. The ECB also is aware of the fact that in the Eurozone, just because of the regulated structure of labour, then potentially labour market data on the inflation front could be stickier. And they have, as Jean-Claude Trichet used to say, a single needle in their compass. And it is but one thing, and that is inflation.
Feels like the Bundesbank's back in charge over at the ECB. There is a fee for this guest appearance from Guy Johnson. The fee is a promo. Don't miss Guy Johnson's interview next hour with Chris Williamson, the chief business economist at S&P Global Market Intelligence. You happy with that?
Absolutely. He's the man that put the data together.
Looking forward to the programme, Guy. It begins in about 7 or 8 minutes' time. Let's get you some sector price action. We can do that with Abby. Hey, Abby.
Hey, John. Yeah, well, we do have the S&P 500 right now down about 0.3%. Not surprisingly, most sectors are lower, led by materials. We also, I just want to mention, have an update on that NYSE trading situation. They're saying that all systems are normal. They're not saying what happened, but it does sound as though they're admitting that there was an issue of some sort. But at this point, again, all systems are operational and normal. And then, John, I have a board for you that I have a feeling you are going to really like, because I know you like a board that shows a simple story. So if we take a look at what's happening year to date, it's extraordinary, this rally that you've been talking about with all of your guests this morning. The NASDAQ 100 up 8.5%. China tech up 19%. But then take a look at some of last year's better sectors, the defensive sectors. Healthcare and staples, they are down. So this is the story. Growth is in, value out right now.
Abby, thank you. Stocks down 0.25%. Your trading diary up next. 25 minutes into the session here, equities on the S&P trying to recover. We're down about 0.2%. The Nasdaq slightly positive, up 0.1%. Over the next week, 25% of the S&P 500 reporting earnings. It really kicks off big time with Microsoft after the close. In the trading diary, not just that, President Biden meeting with top Democrats at 3 p.m. Eastern time. Microsoft, as I say, after the closing bell a little bit later. Results from Tesla, IBM coming up on Wednesday. US fourth quarter GDP and another round of jobless claims coming up on Thursday. And finally, PCE numbers and the UMich sentiment survey to round out the week on Friday. Live from London. That does it for me. Thank you for choosing Bloomberg TV. For our audience worldwide, this was the countdown to the open. This is Bloomberg.